Welcome to this webinar on tax liens, withdrawal, subordination, and discharge. My name is Jason Bowman from taxmarketinghq.com. And for the next 50 minutes, we are going to be talking about the wonderful and wacky world of notices of federal tax lien. Now, obviously, tax liens arise when there is a federal tax liability incurred either by an individual or a business. And so we are going to be talking about some of the tools available to you to use in your resolution processes to work with the liens and to use the liens themselves as a tool for resolving the taxpayer situation. Our objectives for today are to explain the difference between lien withdrawal and lien release. The two terms are often used interchangeably by practitioners in day-to-day conversation. But the reality is that there is a significant difference between the two. We're also going to make sure you understand the conditions for lien withdrawal, understand the process for lien withdrawal, and know how and when to utilize subordination and discharge processes, as well as the differences between those two processes. Now, in case you can tell from the course objectives, a significant portion of this morning's presentation is going to be on the lien withdrawal process. This is by far the more common thing that I get asked about by practitioners. And it's one of the more common things that your clients are going to ask you about as well, because, quite frankly, nobody wants a tax lien against their business or showing up on their personal credit report. So it tends to be a pretty significant portion of the questions that you will be asked as a tax resolution practitioner. So let's start with what I think is probably the single most important part of this entire concept here. A lien withdrawal is not a release of the tax lien. When a federal tax liability exists, there is a statutory tax lien that encumbers all property and rights to property of a taxpayer. That lien exists by statute regardless of whether or not the notice of federal tax lien, the 668Y, the paper lien, if you will, actually exists, is filed, is recorded with the county or the Secretary of State. The statutory lien exists regardless of the presence of the paper lien or not. The paper lien is the notification to the world about the statutory lien. Okay, so the process of lien withdrawal removes the paper lien, but it does not release the statutory lien. So when there is a withdrawal issued, it'll be issued on a 10916C. That's the withdrawal. The 668Z is the release. So you're not going to get a release of lien until the underlying liability has been paid in full and or the collection statute expiration date. The statute of limitations on collection of the tax liability has passed. It takes one of those two conditions to release the lien. So I want to make sure that that's very, very clear, the difference between the withdrawal and a release. Now, there's some benefits to having the withdrawal, the removal of the paper lien from public record. Obviously, if one of the biggest things that you're going to see is that a tax lien will impact a taxpayer's credit. Okay, when this public record shows up on a credit report, that is not a good thing if they are trying to obtain credit, or if they rely upon certain types of credit, such as factoring of their accounts receivable for their ongoing operation. So under the law, there are specific conditions under which a tax lien can be withdrawn. The process of withdrawing that lien under the law also provides for third-party notification, such as to credit bureaus, credit reporting agencies. So the four primary conditions under which a tax lien can be withdrawn are if it was filed prematurely. So if a situation arises where a tax lien would normally be filed, but there are extenuating circumstances such as administrative procedures or other factors that would normally mean that the 668Y, the notice of federal tax lien, would not normally be issued, that can be an allowable condition for the withdrawal. Under certain conditions, if a installment agreement is reached to satisfy the tax liability with payments over time, then the lien can be withdrawn. There are also situations where it's simply in the best interest of the government to facilitate collection, to help them get paid, where they're going to be willing to withdraw the lien. And then lastly, there's this kind of catch-all within the Internal Revenue Code where the best interest of the taxpayer in the United States are taken into consideration. These are special cases, almost always handled by the taxpayer advocate office, and we won't be covering taxpayer advocate involvement in today's webinar because those are special cases. We could talk for several hours just about that, because the taxpayer advocate only gets involved in certain circumstances. They are not a catch-all for addressing tax controversy problems. So we'll primarily be talking about the first three, but know that if your client is in a situation that the taxpayer advocate is willing to look at, then the lien withdrawal through the taxpayer advocate is a potential avenue for getting this withdrawal. And if you want a reference for this, it's Internal Revenue Code section 6323J. So let's talk about premature filing, also sometimes referred by the service as inadvertent filing. Sometimes the centralized lien unit or a service center will file a lien by accident, even in a condition where they normally would not have done so. So the first one is under normal administrative procedures. There are administrative procedures that the IRS follows for the filing of liens, obviously. And sometimes these procedures specifically state that the lien will not be filed under conditions XYZ. And like I said, sometimes the centralized lien unit or a service center does not fully follow these procedures, and therefore a lien gets filed. So, for example, if a taxpayer has a credit from one tax period that will roll forward to offset the liability for a later tax period, and there's no dispute, about adjustments or anything related to the tax period that's going to roll forward, and that would basically wipe out the liability, then under IRS internal administrative procedures, there should be no lien filing under that circumstance. So if there was a 668Y filed, but the credit rolled forward, eliminated the tax liability, then obviously that was a premature filing, and you can apply to have the tax lien removed. Bankruptcy is another situation where the government should not have filed a tax lien. Because of the automatic stay of enforcement protections that are provided by chapters 7, 11, 13, etc. of the Bankruptcy Code, the government should not file tax liens on that have not already previously been filed. So once you're in bankruptcy protection, the normal lien filing processes kind of go out the door. And if the service does inadvertently file a tax lien during a bankruptcy protection period, then it's actually mandatory that they allow the taxpayer this withdrawal. There are also several situations for active duty military personnel serving in combat zones, or if they have been injured in a combat zone and are recuperating at a facility, be it stateside or otherwise, the notice of federal tax lien should be withdrawn. This is obviously a special protection for service members that are unable to address their personal financial situation back here in the States due to combat action. That obviously makes it difficult for them to talk to the IRS, address the tax liability situation, if they're out serving the country. So another situation, and this is one of the more recent ones actually, MFT 35. If you're not familiar with MFT codes, MFT codes are used internally by the Internal Revenue Service computer systems for identifying specific tax types by code. So MFT 35 refers specifically to the individual shared responsibility payment that we have courtesy of the Affordable Care Act. And if you're not aware of this, the Affordable Care Act specifically states that the normal IRS enforcement and collections mechanisms may not be applied for collection of the individual shared responsibility payment. So basically, the ACA puts this tax in place, but did not provide an enforcement mechanism. So in case you weren't aware of that, yes, a taxpayer can, as long as their income tax liability is paid, if they, for whatever reasons, are not carrying health insurance as required, and they also refuse to pay the individual shared responsibility payment, then a tax lien may not be filed, levies may not be issued by the IRS to collect that money. Okay. However, we will be seeing this. There will be, I guarantee that over the course of the next few months, as we come out of the first tax return filing season where this is a potential issue, you will start seeing cases where these liens are issued on MFT 35, the individual shared responsibility payment. And because the law specifically says that a lien should not be issued, then that falls into the premature or inadvertent filing criteria for the lien withdrawal. Another situation that arises has to do with LLCs that the service has, and you may have seen this if you've done any kind of direct mail or whatnot with two lien filings. You'll see that there's a lot of LLCs these days where the tax lien is filed under the name of the LLC, but with the name of an individual included in the lien as well. The IRS does this specifically on payroll tax liens in particular, for small businesses, and especially if the LLC has not elected S Corp treatment. So and especially in new LLCs where there's not even a return history. So if there's no way for the IRS to make a determination of what type of entity classification the LLC is really operating as, they will simply make the blanket assumption that it's a sole proprietorship, or even if there is an election in place, if they have only one person's name on file instead of two or multiple, they'll just automatically assign that person responsibility, and then leave it to be sorted out later. So it is possible for an individual to be named as a responsible party or as a nominee assessment on an LLC-derived lien, even when they shouldn't be. So if that's the case, then there is a withdrawal procedure for that. Lastly, premature filing can also come up in disaster areas. If a federally declared disaster area exists and it was declared prior to the filing of the 668Y, then a relief provision exists in order to help folks out that may need, for example, access to credit to help them rebuild, or to help them move forward with life, basically, easier in those disaster areas. So that is premature filing. Another situation is, and you're probably already familiar with this, but in an installment agreement IA situation, and if you're new to tax resolution, collections representation, if you're new to this, the vast majority of your cases will be resolved through a payment plan, not uncollectible status, not offers in compromise. The majority of your clients will end up in a payment plan, okay, if you're doing a high volume of tax resolution work. So there are certain situations where a lien withdrawal is essentially an automatic condition of the installment agreement. This was started in 2011 as part of the Fresh Start program, expanded a little bit in 2012. But in particular, the conditions for this are pretty straightforward. A direct debit installment agreement, DDIA, direct debit installment agreement. If the service enters into a DDIA with a taxpayer, then they will withdraw the lien as long as the following conditions are met. One, it has to be an individual tax, so individual master file, IMF. If it's a business, then it needs to be income tax only, or the business has to be out of business. If the business is no longer operating, and this is indicated in the business master file that the business has filed final returns and closed out the reporting requirements and marked as out of business, then they can also get this provision. The balance due, the assessed balance of tax, penalties, and interest has to be $25,000 or less, and the installment agreement needs to full pay the entire liability within 5 years or by the collection statute expiration date, whichever is earlier. So those are the criteria for being able to obtain an automatic lien withdrawal as part of a direct debit installment agreement. So for the majority of your clients, this is going to be individual income tax, business income tax, or the business has gone under and they owe less than $25,000, and they're going to basically qualify under streamline criteria. In the event of a default of the installment agreement, however, it should be noted that the lien will generally be filed within 30 days of a default. And so if a taxpayer is trying to obtain a withdrawal of a lien, and let's say they owe $35,000, one of the things they can do is pay it down to, if they can come up with $10,000, to pay it down to the $25,000 or less category, and then enter into a direct debit installment agreement on the remaining balance, they can get the withdrawal. That is a fairly common resolution situation, especially if they need the lien withdrawal for another reason, such as to facilitate factoring agreements or refinancing mortgages, that sort of thing. But if they then default on that installment agreement, regardless of how much they've paid in, regardless of the good faith positioning of making that $10,000 payment to pay it down, within 30 days of that default, they're going to get slapped with another 668Y. Okay, so let's now talk about withdrawal to facilitate collection. Never forget that the IRS enforcement side and everything that we talk about pretty much is based around the concept of making sure that the government gets their cut. Okay, so while some of these provisions for withdrawal, discharge, subordination, etc., are handy tools for us as practitioners, never forget the fact that they exist exist for the sake of the government. So the liens can be withdrawn to facilitate collection in conditions where the government is going to realize some benefit, either a current benefit or a future benefit. And as a practitioner, that future benefit part is something I want you to keep in the back of your head as we go forward, because there are a lot of future benefits that we can negotiate on behalf of our clients. So liens, the very existence of a tax lien can hamper the ability of the government to get paid. So there are situations. Let's talk. I mentioned factoring earlier. If a business factors their accounts receivable, then a lien could obviously destroy the banking relationship and destroy the factoring agreement. A lot of times you'll take care of this through a subordination, but depending on the factoring agreement, the actual contract with the bank, a withdrawal may actually be necessary. And without that occurring, the cash flow may stop and the government may not be able to get paid. A tax lien can also hamper the ability of a business or individual to make lump sum payments, either from an ability standpoint or a willingness standpoint. Okay, if the government can withdraw the lien or subordinate their position in order to facilitate receiving a lump sum payment, they'll often do so. The government does typically prefer to receive large lump sum payments early in a resolution process rather than installment payments. You're also going to find occasionally that there will be issues regarding employment and maintaining a federal tax lien. So if, for example, an individual works for a defense contractor, homeland security contractor, and they're required to maintain some sort of security clearance. Well, most of the time, those security clearances, part of the determination criteria for granting and maintaining a security clearance is that you have to have good credit. Because the thought process is that if you have financial problems, then that may be you may be more likely to, for example, sell government secrets in order to improve your own financial position. Therefore, the presence of a tax lien or any other judgment or tax problem or a financial problem, credit problem, can result in the removal of a security clearance. And that means somebody could lose their job. Or if it's a business and they have a government contract and it's a significant portion of the business revenue, then the contract may be predicated upon not having tax obligations, or employee security clearances may be impacted by the business's tax problems. These are all things that can happen. So it's not just an individual problem with the security clearances. It could also be a factor for a business that's a contractor, and they could lose that contract, which would obviously kill their ability to make any payments on the tax liabilities. Another thing where you'll see this come up is for financial services folks that have some sort of a securities license. Insurance agents, stockbrokers, even mortgage brokers. Now that there is a national mortgage broker licensing system, this can come into effect. And because those often involve fiduciary relationships between the financial service provider and their clients, the assumption again is that if the financial services professional has a credit problem, a debt problem, a tax problem, then that may impact their judgment and may lead to an increased risk of embezzlement. And therefore, those securities licenses can be revoked or not renewed if there is a tax lien present. Therefore, they could lose their job. So the withdrawal of the tax lien in order to maintain employment is actually a fairly common one, depending on what your client base looks like. And removing that tax lien so that they can keep their job, obviously that's going to facilitate collection. With tax lien withdrawal requests are filed on IRS Form 12277. And as you can see here, it's pretty straightforward. Taxpayer's names, identification number, your representative information is included on here. They do want you to attach a copy of the Form 668Y, or if you don't have it available, they'll want to be able to look it up. And I know this sounds strange, especially since we have the centralized lien unit, and ACS and field collection are going to have their files on the taxpayer. So it may seem odd that they want a copy of the tax lien, or at least the serial number and other information so they can look it up. You would think they'd have that. But the reason for this is because tax liens can be filed in series. So for businesses in particular, if they're pyramiding liabilities every single quarter on payroll taxes, there will be multiple 668Ys that could be floating around. And so in order to identify all of them that you are applying for the withdrawal of, it's best to attach every single one of them, even if there is crossover in the tax periods. You also want to indicate the reason for requesting the withdrawal. And these reasons cover the items that we've already discussed. So the notice of federal tax lien was filed prematurely or not in accordance with IRS procedures. Taxpayer entered into an installment agreement. And there's the direct debit provision. Withdrawal will facilitate collection. And then there's the taxpayer advocate provision that we're not going to really delve into. And then the biggest block on the form is the block where they ask for your actual explanation. So, for example, if if you're working with an individual taxpayer that owes a 1040 liability, and they work for a defense contractor, and they could lose their security clearance because of any dings that show up on their credit report. And let's say those are pulled quarterly by the security clearance organization that grants those. So if Homeland Security sees the tax lien show up, then they could say, okay, this person loses their job. Well, that will be where you explain that situation, and then you'll say, if this individual loses their job, they will not be able to maintain their installment agreement payments. Therefore, release of the federal tax lien facilitates collection. Those kind of cases are actually pretty straightforward, and obtaining a lien withdrawal in those situations is I'm not going to say it's rubber stamped, but they're fairly straightforward. So how to file these? If a taxpayer is working with a revenue officer in the field, then the application will be filed directly with the revenue officer, of course. If there is no revenue officer, then file the application directly with the advisory group. This is formerly known as the Technical Services Advisory Group, but now just Advisory Group. The service areas, the geographical service areas, and the addresses for those can be found in Pub 4235. And whenever you send the mail, always address these to the Advisory Services Group Manager. That's who you want those to go to. If you have a collections due process appeal or a collection appeal, CAP appeal, that is going on, and the lien factors come up in the discussion in appeals can facilitate the withdrawal of the tax lien on behalf of your client. So it does not need to be, the case doesn't need to be assigned to collections in order for this to happen. The case can exist in other units. So the withdrawal request can be part of the resolution that is reached with appeals. And a lot of your installment agreement cases end up being settled in appeals. So it's good to know that appeals has the authority to process these. Always be prepared to submit supporting documentation, and examples of this might be copies of factoring agreement. The IRS is going to want to see, or say the advisory group in particular is going to want to see the contract language in the UCC, the UCC1 in particular, for a factoring agreement saying, if you incur a federal tax lien, then we are not going to factor your receivables anymore. They obviously want to see that. Same thing with, for example, the security clearance aspect. The employee should give to you a copy of the security clearance standards from the employer, and specifically where it says, the lack of an ability to maintain your security clearance is a condition of employment. Okay, most of those types of jobs will have that language in like employee handbooks and in employee contracts, but you'll want to get a copy of that because you'll need to submit it to the advisory group to support this withdrawal request. And then also, you need to specifically request third-party notification of the withdrawal of tax lien. So what I mean by this is, if a third party needs to be notified, such as a security clearance provider or a credit reporting agency like TransUnion, Experian, Equifax, you need to specifically request third-party notification. If it's a short reason, you can just include it in box 12 on the application form itself, or you may need to attach a letter of explanation saying, and a release, so it's got to be signed by the taxpayer saying, I authorize, because it is personal information, I authorize third-party notification
of the lien withdrawal, please fax a copy of it to this fax number. Because a lot of banks and other entities that are going to be that you're kind of doing this process for that are third party involvement, they're not going to accept notification directly from the taxpayer or from us. They want to receive something official directly from the government, of course. And it is much faster to have a revenue officer or an advisory group manager or an appeals officer send this directly to the organization that it needs to go to, rather than waiting the 2 or 3 months that it's going to take to filter down through the public records process, and it's where the third party can look it up with the county or the state to see, okay, it's been withdrawn. It's much faster to do the third party notification, but you have to be sure to request that notification with your application and provide a written statement from the taxpayer saying that they authorize the disclosure of that information. So now let's, as I mentioned, we're spending the majority of this presentation talking about the lien withdrawal process. But now let's get into the subordination and discharge processes. I'm covering these together because they're actually very similar. They have similar purposes, similar uses, similar applications. The forms are almost identical. Before there was a form, the form is only a few years old. Before there was a form, we had to submit them in a letter format, and the letter format was almost identical. So, but we'll start with subordination. Lien subordination is different from a withdrawal because it does not release or withdraw the lien. There is no removal in any way, shape, or form of the lien in a subordination process. And this is important. What a subordination actually does is that it moves the federal tax lien to a junior position. Okay, it allows another creditor to have a senior superior claim in the lien priority order over the United States government's position. And one of the little known things about a federal tax lien under federal law and the Uniform Commercial Code is that after 180 days, a federal tax lien will become superior to a UCC1. Okay, so this is particularly important in terms of things we're going to experience a lot of in our day-to-day practice operations and tax resolution. It's the factoring, okay, or a leasing agreement. So any assets, be it accounts receivable or equipment, anything like that, that is collateralized or used as collateral for a UCC1, 180 days after the 668Y, the Notice of Federal Tax Lien, is filed, the 668Y becomes superior to whatever existed previously. Okay, so this becomes, when you look at factoring agreements, this gives the business 6 months to address the tax debt situation. And if they don't, once the federal tax lien becomes superior to the bank's UCC1, it is guaranteed that the factoring will be cut off. Okay, so this is a particularly poignant example of when a lien subordination comes in handy. To apply for a lien subordination, you're going to use Form 14134. And like I said, the application form for a subordination and a discharge are almost identical. The discharge application form is 14135.
You're going to have to describe the collateral in question, and you're going to have to identify the lender. So the reason that I'm pointing that out in particular is because you cannot submit a subordination application that is general in scope. So you cannot subordinate a tax lien to nothing, okay, or to yourself. That can't happen. So there has to be underlying collateral and an underlying third party that you're subordinating to. And people do try to subordinate liens to themselves or to their own business, and that those applications get thrown away. Okay, they're not even processed by the service. You also have to cite the specific code section that you're applying under, and keep in mind that the advisory groups have about a 45-day processing time for these. A lot of times they'll get them done in 30 days, but you have to allow for 45 days for them to process these. Because they're doing asset verification, they're doing valuation research, they're doing they're doing financial and accounting stuff to review these applications, and they have a huge backlog of them, and it takes some time to get through those. So the service asks that we give them 45 days, but a lot of times they're done in 35 days or so. The relevant code sections that you have to cite. And if you're doing if you're just filling out the form, these are a check the box. And the basic difference between the D1 and D2 code sections is when the IRS gets paid. So under Internal Revenue Code section 6325 D1, the service is going to receive a payment amount on a dollar-for-dollar basis that is equal in amount to the government's interest in the property in question, okay? And they're going to get that money now. The 6325D2 is, like I said, the IRS gets paid later. So this is a facilitation. D2 is a facilitation of collections thing. Ultimately, the IRS will later on receive an amount of money. So, for example, subordination to a let's see, if you have a piece of real estate, okay, and this is a pretty common example, piece of real estate where you're going to obtain a second mortgage. And in order to obtain that second mortgage, you need to subordinate the federal tax lien to the new mortgage. And the IRS is going to get the full proceeds of that second mortgage. That's a D1 condition, and probably the most common one that you'll deal with. The IRS gets that money now. D2 is the IRS will get paid later. So, for example, that's more along the lines of the factoring example. So, by subordinating the federal tax lien to the factoring finance company, the business will be able to maintain their cash flow and will continue to make installment agreement payments from that cash flow. And so in that scenario, the IRS gets paid later. The mortgage example and the factoring example, those are the two most common things that you'll actually see. We're not going to discuss 6325D3. This pertains to estate tax liens on farm property, and you cannot use the form 14134 for these situations. You have to actually submit the older style letter application, but see publication 1153 for further information on that. Real quick, let's talk about discharges. Discharges are a handy tool when a taxpayer wants to dispose of a specific asset that is covered by the tax lien in order to either to cut down on equipment or to facilitate collection. So a lien discharge is not a removal of a lien in general. It is a removal of a specific asset from being covered under the tax lien. So remember, a federal tax lien covers all property and rights to property of a taxpayer. So for an individual, a federal tax lien covers their house, their car, their paycheck, everything. Okay, their furniture, stamp collections, a whole 9 yards. So if they want to remove one asset, say a boat, they want to remove the boat from being covered under the tax lien, then they will apply for a certificate of discharge. I mentioned earlier the form 14135. It's almost identical to the 14134. And again, just like a subordination, you have to describe the asset, but you also have to lay out the disposition details. So the IRS wants to know, who are you selling it to? What are the financial terms of that sale? How much money are you getting now? Are you doing an installment contract where you're going to get paid over time? The IRS wants all those details, specifically so that the advisory group can follow your calculations to determine what the government is going to get out of this. Okay, remember the point of these tools is to facilitate resolution. And just like the subordination, those estate tax liens require special processing under Code Section 6325C, and we're not going to delve into those here. Those are rare and specific situations that we could talk about for an hour by themselves. So I know this is a lot for one slide. I probably should have broken this up into multiple slides, but these are the discharge code sections. And just like a subordination, you have to cite the code section that you are applying for the discharge under. Under 6325B1, this is a fairly common one that we will apply under. And the way that this works is that if the IRS agrees to let you take, for example, the boat out from under the tax lien, then whatever assets you have left have to be equal to 2 times what you owe. Okay, so let's say somebody owes $50,000 to the IRS, and the boat is worth $50,000. Okay, but not all of the proceeds from the sale of the boat are going to go to the IRS because there's commissions to pay the yacht broker, things like that. So, and maybe there's some maintenance that needs to be done on the boat in order to get it ready for sale, etc. So let's say the government's only going to see, half that money. They're only going to see $25,000. So in order to apply for the discharge under B1, if the government's going to get $25,000 from authorizing the discharge from the sale of the boat, then whatever other assets you have left have to be equal to at least double the remaining tax debt, which in this case, 2 times $25,000. You have to have at least $50,000 in other assets. That might be your home equity, equity in tools, stamp collections, coinage, cash, retirement accounts, etc. So this is a fairly common provision to apply for a discharge under. B2 has 2 subsections. B2A is when the IRS is going to receive the full amount of their interest in the asset up front. So in the boat example, if the math works out after commissions and repairs and transportation of the boat, that the IRS is going to get $25,000, if you give them that $25,000 up front before the sale, then they'll release their claim on the boat. Section B2B is if the value of the government's interest in the asset works out to zero. So if it's not worth anything, or if after commissions and other expenses involved in the sale of an asset, if there's nothing there for the government to get, if that's zero, then they'll generally allow the discharge. B3, this is when the government's going to get paid later rather than up front. So the sale proceeds are escrowed, and the IRS gets their share out of it. Section B4 is if the third party to the transaction, usually going to be the buyer, if they put up a bond for the value of the government's interest in the property, then that will also facilitate the discharge. So real quick, the subordination and discharge commonalities, you can expect things like title reports that the advisory group is going to want to see. You can expect that they're going to want appraisals. And sometimes it's hard to get full-on appraisals. I've done these discharges where, particularly on like industrial equipment, where it's really hard to determine what something is worth. But you'll need to contact industrial auction houses. There's an industrial equipment section on eBay where you can search completed auctions, for example, and find out what things like bulldozers and concrete mixers and things like that are worth. And if you pull several of those in a report, then you can submit that as data without getting a formal appraisal. For real estate, getting what's called a CMA, comparative market analysis, exact same thing by another name as a broker price opinion, BPO, from a real estate agent will often be sufficient for proving the value of a piece of property. And those will run you, $50 to $100 compared to, say, $500 to $1,000 for a full-blown appraisal from a licensed appraiser. So just some tips on how to prove valuation. Subordinations and discharges are also asset specific. Okay, they're very specific to specific pieces of property, specific lending situations. They are not general. The withdrawal process is what you have to go through if you're looking for a general approach to this. And keep in mind that both of these processes are driven primarily by the math. And the advisory group person that is, most advisory group employees that are evaluating this, they have, their degrees are in finance or accounting. And so they're just crunching the numbers. And so it will behoove us and allow us to provide better service for our clients if we're doing that math ahead of time and only submitting these things that are likely to actually get through. The math has to support our application. So these are three very handy tools to help negotiate and facilitate resolution of tax liabilities. Sometimes it can be difficult to explain to our clients why they may not qualify for a withdrawal of the lien, but there are very specific criteria. Fortunately, there's a lot of them, as we discussed. And the one that we didn't really discuss was if their case qualifies for taxpayer advocate intervention, which is, and just to put it out there, the most common situation there is going to be extreme financial hardship. Okay, that's where you're going to want to get the taxpayer advocate involved and get, their involvement in the lien withdrawal process. So be sure that your clients understand the purpose of the withdrawal, subordination, and discharge application process, and make sure that they understand, for example, that they can't just sell the boat without going through the discharge process. That can incur potential legal ramifications that are not going to be fun for them to deal with if they try to circumvent that process. And don't be afraid to explore outside the box options that could apply to these tools. A lot of my tax resolution experience has to do with working with trucking companies and working things out with their factoring agreements. I spent a lot of time being involved directly with the banks. So don't be afraid to get kind of down in the trenches on this process and be creative. Look for solutions that work for both your client and the government, and for whomever may want to buy an asset, or for a creditor. Don't be afraid to get down to the nitty gritty and work out creative solutions. You'll be surprised at how receptive the service can be to some creative thinking where these tools can be applied. Especially if they can benefit either current collection, future collection, even future collection that extends out a couple of years. There are situations that I've worked with where these tools facilitate collection 2 or 3 years down the road, but things need to be set in motion now. So explore those outside the box options to better serve your clients and to facilitate the service's goals as well. So it's win-win-win. All right. Thank you for taking the time to attend this presentation. My name is Jason Bowman from taxmarketinghq.com. And I appreciate you attending, and I'll talk to you soon. Bye-bye.